Hello, it's Jason here, and today we're talking Canadian exit taxes again, but what is departure tax and how does it apply to me? That is the question. Well, departure tax can refer to the tax implications which arise when you cease to be a taxed resident of Canada, and can be pretty complicated. It can be simple, it can be complicated, but again, it always depends on your situation. So usually what occurs if you have some sort of property that needs to be disposed of, it would be going through something called a deemed disposition. And so when a taxpayer ceases to be a resident of Canada, they're deemed to have disposed of each property that they own immediately before the time of departure, and the proceeds equal to the fair market value of the property at the time. So what that means is any accrued gains that occurred on the property at the point in which you leave Canada, it's theoretically sold, and then you'll need to pay the gains. So for example, if you bought a property, well, not a Canadian property, if you bought a property overseas, and it was valued at 100,000 Canadian dollars when you bought it, and then you leave Canada 5-10 years later, let's just call it 10 years later, and now it's worth 200,000 Canadian dollars. Well, the fair market value is 200,000 minus the original 100,000 you paid, and the 100,000 gain is the capital gain, the total capital gain that's been made, and then you'll need to pay the departure tax on that at the applicable rates. So not everything is created equal. Not everything has to be deemed to be disposed of or sold before you leave Canada. So real or immovable property situated in Canada and some other special types of property, they don't need to be going through a deemed disposition. Certain capital property that's used in a business doesn't need to be disposed of. And there's just a whole bunch of different types of property and nuances that do apply or do not apply. So it can get very complicated depending on how complicated your situation is. So if you own a lot of different assets, you own several businesses, properties, rental properties, as well as properties overseas, stocks, US stocks, etc., RSPs, TFSAs, the whole gamut of different things. Different rules apply to different types of property. So there are reporting requirements for this. So when a taxpayer ceases to be a resident of Canada and they own reportable properties and the total fair market value of these properties is greater than 25,000 when you leave, this needs to be reported on certain forms. So there are special considerations. So that, if you do dispose of a property from overseas before, actually sell it, not go through a deemed disposition, you can be subject to having a foreign tax credit applied, that kind of thing. But again, the situation is difficult, and likely if you have several types of assets, departure tax is going to apply to you. And you'll need to really plan and circumnavigate this, because it isn't as simple as everyone thinks it is. But if you just hold cash, if you hold $1 million in cash, there is no departure tax on that. So if you are confused, and it is confusing, don't be afraid of it. Just deal with it, and that's why we're here to help. So my name is Jason from Fix My Books, and if you have any questions, feel free to reach out to us. And if you found this video helpful, please like, share, subscribe, and send it to anyone that's also having this issue. Thanks.